Welcome to our Aon Insights Masterclass, Rethinking D&O. My name is Jennifer Richards, and I'm Managing Director of Aon Specialties Business. The goal of our session today is to shed some light on the dilemma facing boards of directors across Australia and, in fact, across the globe, as they grapple with the drastically changed D&O market paradigm, which has seen Australia move from being the cheapest and most plentiful D&O market in the world to the most expensive in the span of less than a decade. As attested to in the recent report published by Kingwin Mallisons, spiraling D&O costs are front of mind for the boards of directors across the nation, with 50% citing it as a key policy reform area. We don't wish to dwell today on the problem statement itself, as much has been written about it and said about it. But instead, we'd like to spend our time today exploring solutions and different approaches to question convention and even turn the traditional paradigm on its head to help our clients regain control over their own destinies. First, why don't I make some introductions and introduce the panel that we've assembled here today. We're joined by Eden, who leads our financial lines practice in Australia and is a member of Aon's global financial lines leadership team. Kristen is Aon's national D&O practice and product leader in the United States and has over 20 years of experience in placing complex D&O programs. Lucy is a partner at Clayton Utz in their insurance law practice and regularly advises clients on the scope and purchase of their D&O renewal programs. She has been very, very busy in recent years, and certainly our paths continue to cross. You have access to all the panelists' biographies for more details about their numerous achievements and accolades, and so I'll leave it to you to peruse those at your leisure. I'd like today to start by setting the scene of this D&O dilemma and ask Eden to provide a short overview of the prevailing market conditions that we're seeing in respect to rate, capacity, and coverage, as well as some insights into what's coming in the coming months. Eden, over to you.
Yeah, thanks, Jen. Look, I might firstly start with COVID, because I think, broadly speaking, COVID has hit the insurance market very hard, with its direct impact being likened to 9/11 or the combined effects of hurricanes Katrina, Rita and Wilma. Certainly some of the statistics that I've seen suggest that COVID could be the market's largest ever single loss event. But I think beyond its direct effects, the pandemic has acted as a bit of a catalyst, I guess, really hastening and intensifying change in what was already a hardening market environment. So the immediate impact on capacity is really compounded by concerns by insurers over the ensuing economic downturn. And this certainly plays through to the D&O insurance marketplace in the context of securities class actions, corporate insolvencies, and employment practices related claims. But I think certainly leading up to COVID, capacity in the marketplace was already contracting. So as it applies to Australia, this has primarily been driven by securities class action litigation, with cumulative settlements now in excess of $2.1 billion. Certainly another key driver of claims has been investigations by ASIC and other regulatory actions. Insurer appetite continues to deteriorate for participation on listed D&O programs below an attachment point of $100 million. And this is having a material impact on both pricing and self-insured retentions. We have seen a further material deterioration over the past 6 months, with most insurers looking to reduce capacity deployed on existing business written. So on an aggregated basis, this translates to roughly $100 million of capacity that's exited the D&O market that was available to Australian insureds at this time last year. In addition, few insurers are actively seeking new business at the current time, so the cost of replacing that lost capacity is materially higher, which is resulting in some very dramatic movement in premiums. We are also seeing non-listed organisations heavily impacted by the current market dynamic as insurers look to reprice their entire portfolios. But there is some specific concerns around corporate insolvencies in the SME segment in particular. We have seen an increased overview of underwriting decisions within insurers and certainly a limitation of individual underwriting authority. So this means that underwriters have less ability to navigate outside of their actuarial model pricing guidelines and are therefore generally less accommodating. So I think really to summarise, the market is such that underwriters are very much prepared to walk away from risks that, in their opinion, don't fit their risk appetite. or if they do, fail to attract adequate premium. Certainly for clients in more challenging industries or those who've historically purchased large policy limits, the current market is certainly leading to a reassessment of limit requirements and program structures in particular, given both the limited availability and increasing costs of capacity. There has been some commentary that suggests that Australia has been or has become the most likely jurisdiction outside of the United States in which a corporation may face significant class action litigation. So as reflected in the current slide, median rates and retention levels for mid to large cap organisations. So these are ASX listed organisations with a market capitalisation in excess of $5 billion, are now well in excess of US peers. Australian retentions are broadly more competitive in the small cap space. And that's primarily driven by the fact that class action activity has historically been limited to the ASX 200. Look, in terms of outlook, I think candidly, it's very difficult to predict. Certainly off the back of large pricing uplifts, D&O portfolio profitability for insurers is no doubt improving, albeit as the COVID legislative emergency measures cease, insurers will closely monitor claims trends and naturally respond accordingly. Finally, the parliamentary inquiry into the class action industry, which is due to report in December this year, may provide some positive direction in relation to Australia's continuous disclosure regime. However, insurers will naturally be cautious in their assessment of any positive developments in the short term. Thank you.
Thanks, Eden. In light of this change in the market that we're seeing, do we need to fundamentally rethink the way that we're approaching D&O program design and placement?
Yeah, I think it's a really good question, Jen. I think the evidence does show a clear trend. The D&O market is changing, and the pace of that change is obviously gathering momentum. I think certainly the traditional block and tackle approach continues to apply, and clients need to adopt a very proactive approach to manage uncertainty. I think firstly, clients need to recognise that the renewal process will take considerably more time than in previous renewals. Preparation is everything, and certainly underwriting submissions need to include everything that underwriters might require to correctly understand and price the business. Clients need to give insurers obviously the best opportunity to understand the organisation, and underwriter presentations continue to be a really valuable way of articulating the culture of the business. These do, however, need to be carefully planned and rehearsed, noting that it is effectively a competition for insurer capital. I think insurer choice is extremely important, and clients should work with their broker to really leverage any cross-class relationships, but also understand an insurer's full value proposition. I think it is important to recognise that claims paying willingness is changing off the back of insurer profitability challenges, and we're currently using a lot of data and analytics around claims capabilities in particular to help inform clients. We're also using data and analytics to really help inform the go-to-market strategy and help identify the best jurisdiction to access a particular insurer. So the reality is the Australian insurance market has had an over-concentration to Australia-specific issues such as securities class action claims and obviously losses associated with the Royal Commission. So we're monitoring insurer behaviour globally and in a number of instances accessing those same insurance markets in other regions with a view to leveraging a more global view and a deeper premium pool. And certainly this strategy can also facilitate engagement for our clients with key decision makers at insurers. I think there is a clear structural shift in the market taking place, and it's important to recognise that a significant number of clients did utilise savings that were generated during soft market conditions to purchase additional limits. So ultimately, the current market does represent the right opportunity to revisit the appropriateness of the current structure relative to an organisation's own risk appetite. And I think certainly benchmarking continues to play a key role, and we're spending a considerable amount of time with boards to interrogate those historical D&O purchasing decisions, very much relative to what peers are doing in the current environment. To date, we haven't seen many clients remove Side C from their D&O insurance programs. The amount of Side C cover being purchased and how organisations balance the priorities of the entity relative to insured persons is, however, changing. And this is obviously a key lever available to clients to aid the mitigation of pricing increases. And I think finally, analytics is playing a more meaningful role as organisations look to balance the cost of risk transfer with their own appetite. So we're working in conjunction with our risk consulting teams to review things like claims data. So as an example, the probability of a securities class action impacting an ASX 200 company is about 11.5%, with only about 24% of those claims also joining individual directors. We obviously know that the average securities class action settlement figure is approximately $45 million. However, in the current environment, many ASX clients continue to purchase side C limits of considerably more than this amount. So we're taking this historical claims data and overlaying with client-specific metrics such as stock volatility, liquidity position, industry, the regulatory environment, the increasing costs of defending litigation to really create some more meaningful loss modelling for clients. And this is allowing clients to conduct a bit of a reset of their current D&O insurance arrangements by ultimately better quantifying how big their D&O loss exposure might be and how much risk they're retaining. So ultimately, we're augmenting traditional benchmarking capabilities to help clients better quantify exposure to loss and really evaluate the effectiveness of alternative insurance program structures, including captives and protected cells.
Great. Thanks, Eden. We're going to now move to Kristen. Unfortunately, she's had a little bit of problems from a technology perspective, so she's joined us now by her mobile, so apologies for that. But Kristen, I'm really interested to get your insights about what the U.S. experience teaches us. As the slide presents here, Australian premium rates are now higher than they are in the United States, with retention levels or deductibles also in excess of the U.S. levels. How are U.S. clients thinking about a more sustainable approach to directors and officers insurance and risk transfer?
Thanks, Jen. We're really talking about taking control back in the market and what vehicles can help our clients do that. And there really are so many parallels with what you're experiencing in Australia and what we've been seeing here in the U.S. for really the last kind of 2 years, but in earnest over this year. So some of the metrics that Eden was mentioning around increased class action litigation, we're certainly seeing that in the U.S. Really over the last 5 years, there's been over 1,000 federal class action lawsuits. And just last year, there were over 400, and we're tracking for those same numbers. The likelihood of being sued as a public company in the U.S. is about 9%, and that compares to prior years at 3%. So the underwriters are really having an acute reaction to that increase in litigation and really the payment of claims and these high trends of class action litigation around event-driven litigation, of which COVID really falls into that category. So in order to take control back, we're talking with clients about really revisiting their program structures, their D&O program structures. So to think less traditionally about just the Side A, B, C and the Side A programs, and to consider some of the more traditional alternatives like utilizing coinsurance or quota shares in these layers to help alleviate some of the pricing. Think about higher retentions and how does that potentially square with their risk philosophies, and what kind of relief can we get through higher retentions with lower pricing. But in combination with just those traditional alternatives, we're really exploring some of the non-traditional alternatives with our clients. Things like utilizing a captive or creating risk retention groups around a single challenge, like, for example, opioids. So let me just make a couple of quick comments on these more non-traditional structures, because I'm thinking about a client where we utilize a captive. It was a large pharma company, and in the 10x of 10 spot, they were experiencing really large pricing increases and not any other market that was interested in competing on that layer. So by utilizing their captive, they were able to really provide a solution to an otherwise really challenging layer. And fronting that policy and providing coverage for the non-indemnifiable or the indemnifiable part of the program, the B side, and the entity coverage through the captive, and then utilizing the traditional market still for that A-sided coverage, because here in the U.S. we have some challenges to that covering the non-indemnifiable feature in a captive. But it really was a viable solution. It allowed us to kind of mute the pricing and not have such a large reverberation of the pricing up through the program. So really seeking out those alternatives has been a large part of our discussion with clients. But I have to also add is that really, particularly the non-traditional options, they require a decent runway to plan for it, because you can't just pivot in the middle of these programs and decide to utilize a captive. There's so many constituents that are at play, legal issues, the regulatory component to it. So it takes planning to do that and to start to think about that well in advance of a renewal, and as a part of really your holistic risk strategy.
Great. Thanks, Kristen. That's really helpful. And apologies again for the technical issues that we had. Fortunately, we had you at the beginning part of our presentation in any event. I'd like now to turn to Lucy and get her observations around this topic. In particular, Lucy, kind of the observation has been that captives and other forms of, I suppose, more exotic risk transfer have traditionally been viewed as taboo for D&O risks for a host of reasons: price, capacity, and just probably an inherent conservatism around this class of insurance. But as conventional D&O purchasing becomes more and more challenged and unsustainable at pricing levels, what vehicles or structural options are you seeing clients explore in the Australian context?
Thank you, Jen, and thanks very much for having me. I guess where I work is predominantly with policyholders. So I, as Jen mentioned at the very outset of this session, I have on many occasions worked with Aon, with our mutual clients, to find some alternatives and some different strategies to manage what is currently a really difficult environment in Australia. I know Kristen touched on quite a few of the options that we've been exploring. Some of them are a bit fraught from a legal perspective because, as Kristen mentioned, in the US, there are some prohibitions around circumstances in which a company can indemnify its directors or a related entity can indemnify its directors, and those prohibitions exist in Australia also. So there are some restrictions from a legal perspective around what you can do. It's all well and good to put your creative thinking cap on, but if there are substantial legal hurdles, then that's something that you have to be really careful of. And there's certainly some solutions that we're exploring that may have some challenges, but we think they can be overcome. So I guess just to take a step back for a minute, obviously Australia's in a pretty unique and difficult position because our continuous disclosure obligations are unique from other common law jurisdictions. The core issue is that liability for breach of continuous disclosure requirements or misleading and deceptive conduct doesn't require proof of intention, recklessness or negligence. And so that's an additional exposure level for directors and officers in Australia. And I know Eden referred earlier to a report that's coming out probably late this year, that may make some recommendations in relation to changing that legislation. My pessimistic view, unfortunately, is that even if recommendations are made, law reform may be quite some time off, particularly when the Parliament and politicians, and to be honest, everyone generally is focused on the global pandemic and quite rightly on a number of levels. So we really are at a crossroads with the D&O market for a number of reasons that have already been mentioned. In terms of considering possible alternatives for the D&O cover and managerial liability policies, there's a couple of things you have to consider at the outset. Firstly, what's the original purpose of D&O? Despite the presence of Side C on our current modern D&O programs, D&O insurance wasn't intended to be insurance for the company itself against liability of breach of stock market continuous disclosure obligations. My personal view is that Side C does not belong on a D&O program, and I think we've got a pretty unique opportunity for our clients to look at moving Side C or dropping Side C altogether, or potentially purchasing a standalone Side C policy. So obviously the primary purpose of the D&O policy to cover corporate officers and indemnify them and provide them a means to afford a legal defence has to be maintained in order to provide a practical solution for corporates. Secondly, any proposed solution must focus on maintaining effective functioning boards and management. It means separating their liability, the liability of those individual directors and legal costs, from those of their companies. So as I mentioned, dumping Side C is one potential option. I've heard rumours, in fact, in my recent chats with brokers and underwriters, that Australia buys the highest limits of Side C than anywhere else in the world. And there's a general sentiment that the capacity for Side C is reduced in Australia. So there's obviously a real mismatch between demand and supply for Side C at the moment in Australia. This is obviously one aspect that has led to the D&O dilemma, but it's not the sole driver of the D&O dilemma. And I think the difficulty for policyholders who have historically purchased Side C is that they've become used to having this additional limb of cover under their D&O policy. Directors see it year in, year out, coming back to the board meeting for the insurance renewals. There's ABC. The problem is that getting a company to depart with a limb of their D&O cover is kind of like asking them to cut off a physical limb. It's really difficult to get some corporates to change. And the messages that we're hearing from some boards around Australia is, but why would we make a conscious decision to let go of some of our cover? And the response that we give them is, as I mentioned before, it shouldn't actually be in this program. If you want Side C cover, that is absolutely fine. Let's look at a standalone Side C policy. And the interesting thing about that is you can definitely put that through your captive insurer because it's insurance for the company. So the other issue that I've uncovered in the last couple of months chatting with clients is that even those who do dump Side C, once I can maybe convince them to do so, is sometimes they're not actually attracting the same reduction in premium that they were anticipating. And so, of course, the question then is, well, why am I dumping this if I'm not getting a commensurate cost saving? And so the cycle continues. But there are still, I believe, some really legitimate reasons why removing Side C from the D&O cover, putting it in your captive or purchasing it in the general commercial insurance market as a separate policy has a number of reasons you can do that. The other interesting thing that we've seen is because the insurers are now demanding such high retentions for Side C cover, you can actually put Side C in your captive and use alternative risk transfer methods to manage that retention in the captive. So all of these solutions that we're mentioning today, they're not mutually exclusive. We're not looking at a situation where you say, well, you can only use your captive or you can only use alternative risk transfer or you can, the only option is to drop Side C. And this is where I think people have to become and I say people, us lawyers, brokers, underwriters, all have to become a bit more flexible with our thinking around this in terms of how we might come up with a solution that suits the particular company and is consistent with the risk appetite of the particular board. So the other option that we've been looking at is, aside from ditching side C, you could also ditch side B as well and have standalone side A policies. Some clients have done that and they've seen a really good reduction in price. Obviously, there's some downsides to everything, and the practical effect of a side A only cover in an insolvency scenario will potentially make the directors and officers an attractive recovery target for creditors, disgruntled investors and class action lawyers and funders. And also the levels of self-insured retention that have been applied in the past to side B to try and keep D&O premiums manageable can't obviously be imposed on a side A only policy. So there are some downsides to that as well. A captive D&O insurer I touched on just a moment ago, there are some issues there because you can't have the captive insurer underwriting side A because of the prohibition in section 199A of the Corporations Act in Australia. That says you can't indemnify directors against prescribed liabilities and legal costs. I won't go into the details of that specifically, but one option for captives is a rental captive or a segregated cell, which I know Aon is looking into for a number of their clients, and we think, I agree that that's definitely something worth looking at. The other interesting one that I definitely thought was an option was a mutual. I can hand on heart say that some brokers have completely shut me down with that idea on the basis that it's too expensive, difficult to find enough friends to come in the mutual with you, and there's some specific regulatory issues as well to potentially overcome. That is, however, I think that is still an option for some industries. I mentioned alternative risk transfer. That is a fairly large beast, but there are a number of options there through insurance-linked securities, derivatives, and essentially contracts that resemble credit default swaps, ideally between clients with offsetting or counter-cyclical D&O risk exposures. So there are a number of options out there, and one interesting jurisdiction that many clients are looking at is Singapore, because the Monetary Authority of Singapore is offering some really interesting incentives to get people to look at Singapore to place their alternative risk transfer instruments.
Great. Well, that's certainly the topic for a further session, I think, Lucy, as we get a little bit more advanced in some of these alternative risk solutions. And I think we'd love to convene another forum on that. The comments that you made just around these arrangements not being mutually exclusive, I think really resonate with me. And I think that's really the key to this discussion, is that it's not a one-size-fits-all approach. I think the class of D&O insurance, in and of it, by its very nature, is very personal. And I think board sensitivities around things like how much A side they carry, how much B side they carry, I think is, it is quite a personal discussion, and I think we have to approach it that way. But certainly your comments on side C are interesting and really resonate as well. So thank you for that. Well, we're at the end of the session today. I wanted to thank our panelists very much for joining and sharing their insights. As I noted in the opening of the session, our goal really for today was to provide some food for thought about how insureds can challenge the traditional paradigm and think differently about why and how you buy D&O insurance. In the face of a market which I think for many of our clients feels absolutely unrelenting, I think the time is right for people to start to explore some different approaches and structures, and whether that's a deep dive from an analytics standpoint around what your exposures are and how you wish to manage them, or exploring, as Lucy said, some more structural approaches, such as using captives or protected cells. I think the time is right. Admittedly, these alternative approaches do require investment, and Lucy and Kristen and Eden refer to these, an investment in time and resources. But we really do believe that they're going to be a critical enablers for clients going forward, just to regain some control over the path forward in this area. So thank you very much for joining us today. It's certainly been our delight to engage in this conversation, and we look forward in engaging further on this important topic. So thank you.